Good morning. So this is going to be our second video in our series going over our pricing engine, which is called LoanSifter. This is an application that imports in all of the lenders that we currently work with, as well as some that you may not work with, because LoanSifter is a group application that a variety of different lenders on our brokers list use. So you definitely want to cross-reference any results that you get against your broker approved lenders list, because just because it shows up in the list here does not necessarily mean that you are approved with this particular lender. But it gives you an opportunity to see what kind of pricing, rebates, or points are going to be available for the different scenarios that you have. So there is a fee for LoanSifter. The basic plan is $59 a month. There is an application, which is just a short form that gives your name, NMLS, address, and credit card billing information. You can email that over to me directly at felicia.howard@elitemortgage-ca.com or to your admin. And then they will set you up with an account. You'll have your own unique username and password, and you'll be able to price. So when you log in from LoanSifter.com, this is the screen that you're going to see. And the nice thing about it is that there aren't that many fields that you need to fill in order to get pricing for your loan scenario. So when you jump in, you will see that on the very top, there will be an option of borrower paid comp. The difference between a borrower paid and a lender paid comp loan is who's paying broker commissions. If it is a borrower paid transaction, that means that we are charging the borrower the full commission or whatever portion thereof, whatever commission that is going to be received on the loan, we are charging that to the client directly. They will see that on their loan estimate as a loan origination fee. The benefit for doing that in a lot of instances is that the interest rate is slightly lower if you choose a borrower paid transaction. The reason for that is because on a lender paid transaction, which means that the bank, the lender that we put our loan through, they will be paying us commissions. And so the borrowers will not see a line item on their loan estimate that states a loan origination charge. But the interest rate is just a touch higher because the compensation has to be included in the rate pricing. So as we go forward, we're going to choose lender paid because the majority of your transactions will be a lender paid transaction. We will just put in a fictional scenario. So first they're going to ask what the property value is. So we'll just put for our scenario that our property value is $400,000. And then they want to know what the loan amount is. So you can either put that in manually, or if you only know your loan to value, you can just plug that in. So if they're putting in a 20% down payment, or if it's a refinance and they have 20% equity, then you can just put 80 right here, loan to value. And CLTV is your combined loan to value, which if there is no second mortgage, home equity line, or any other lien, then these two numbers will be the same. So that gives our loan amount at 320. FICO is the credit score, so let's just say they have a 740 credit score. Down here you can choose, if there's no FICO, how many days you need to lock. If you don't put anything there, it will default to a 30-day time frame. If you want a longer period of time, you need to type that in. Like if you want to look at a 45-day lock, we would type that in. But I'll leave it blank and it will default to a 30-day lock. Then under here, you will be able to see whether you want a fixed, an ARM, a balloon, or various buy-down options. The main two that you will always use is fixed or ARM. So we'll leave it at fixed. For the term, 30 years will always populate, but there are other options. You can look at a 10-year, 15, 20, 25, 30. There are no lenders currently that are offering 35 or 40-year loans, but that was a product in the past. So we'll leave it at a 30-year. LPMI stands for Lender Paid Mortgage Insurance. We'll touch on that in a minute, but that would not apply in this scenario. Interest only option and fee-in pricing. So fee-in pricing is the underwriting fee or the flat fee that the lender that we are placing our loan with will charge us to do the loan. Typically speaking, the majority of lenders will charge a flat underwriting fee of $9.95, though the number does vary slightly depending on which lender you choose. So if you want fees in pricing, that means that instead of seeing an underwriting fee on the loan estimate to our client of $9.95, we can hide that in the interest rate, which means that the lender will not show that $9.95 on the loan estimate. But your pricing for your interest rate will reflect that fee in there. So if you want fees in, you can click it. If you want fees out, which means you'd rather take a slightly lower rate or get slightly better pricing, and just go ahead and show the client that we are charging and that the lender is charging a $9.95 fee, that is your option there. Then when we come up over here, the AUS findings, which is the automated underwriting system findings for desktop originator, desktop underwriter, that's for Fannie Mae. If you want a Freddie Mac program, it's loan prospector, or if you're looking for a manual underwrite, which means that for some reason you were not getting an approve eligible when you ran DU, then we would have to downgrade the loan to a manual underwrite. And we'll talk a little bit about that later. But we just leave it at list all to give all of our options. Product type, conforming, affordable products, non-conforming, FHA, 203K. So there's a variety of different options in here, but the main ones that you'll typically use is your conforming, which means that the loan amount is within the county limits. It is a Fannie Mae or Freddie Mac product. And then for your property type, you will see that there's single family, 2, 3, 4 unit, manufactured, co-ops, townhouses, mixed use, etc. So we're going to leave this one. The one you'll most see is single family residence. You'll also see condos, but you have to be mindful of how big they are. If it's under 5 stories, 5 to 8, or over 8 stories. And sometimes your multi-units, like if you're looking at a duplex, that would be considered a 2-unit property. So we'll do single family detached. That's your standard single family residence. Then you're looking at the purpose of your loan. Is this a purchase? Is it a cash out refinance? Or is it a rate and term refinance? Which means that all we are doing is changing either the interest rate or the term of the loan, but we are not taking any additional cash out. So we will price this as a purchase. HomePath is a down payment assistance program, but we're not going to choose that currently. Escrows, you'll see none waived, all waived, hazard insurance waived, or property taxes waived. We're not going to waive any escrows on this particular loan, though if they had 20% down, they could choose not to have their taxes and their insurance included in the payment. They could pay that on their own when the bill comes due. We'll put in their zip code. Since I'm in Sacramento, we'll just choose Sacramento. Prepayment penalties, 5 years and under, though the majority of all of your loans conforming, Fannie Freddie will have no prepay. And then all investors selected. Then after you've got all of that information included, then you can hit submit and see what options come up for your lenders. So, these are lenders that are on the list that currently are not approved with TransGlobal. So you can tell that because if you look at the comp section right here, it says 0. And TransGlobal's comp agreement, which means on every single loan, this is the percentage that they will get, is 1.5% of the loan amount. So until you see that 1.5, you'll know right off the bat that these lenders are not approved. So if you scroll down, you'll start seeing lenders that are approved, because you'll start seeing the 1.5, or sometimes a little bit slightly above the 1.5, and I'll explain what that is in a minute. So let's go to the very top, because typically the very first lender is your best priced lender on the list. Okay. So if we had a 30-year fixed conforming and we wanted a 3.5 rate, the first lender that we would look at that doesn't have a 0 on this side, we're jumping down here to where it says 1.5, would be LD Wholesale. Now, 3.5%, underneath that it says $1,436. That means that the principal and interest payment on a $320,000 loan that we have up above, the principal and interest payment alone would be $1,436. That does not include any property taxes or homeowners insurance. Then when you go next to the next column, you will see that it's in red. So anything that's in red is going to be a charge to your borrower. So if it is a charge to your borrower, it's called points, which means that they have to pay a fee to get that rate. So 3.5% on a 30-year fixed would cost this client $5,068.80 if you locked this rate today. Okay, the pricing is only good for the day, and sometimes the pricing changes multiple times throughout the day. So you want to make sure you're keeping an eye on that. And then on this loan, the brokerage would clear $4,800. So that shows that the broker compensation is included in this interest rate. So just for the sake of argument, I'm going to go up here and I'm going to choose borrower paid so that you can see the difference. So if you now look and we scroll down to LD Wholesale, you will see, where is our LD Wholesale? Okay, right here. So we have LD Wholesale. Now we can see that that 3.5% interest rate that was costing our client $5,000 in the previous lender paid scenario is now only costing the borrower $268, right? However, in order for the brokerage to get paid, you will have to charge your client the 1.5%, which was the $4,800. Right? So it kind of washes out the same. It just depends on how you want to list it on your loan estimate. Most people, now mind you, points can be tax deductible. You want to tell your clients to check with their accountant or CPA with regard to deductions if by paying points on a purchase or a refinance, because there are some tax benefits available to most people in that scenario. Mind you, you don't want to give tax advice yourself, but you can give general information and just tell them to confirm with their accountant. But that's the difference. So you'll see that the same rate, the overall points for that rate comes down drastically. So I'm going to go back up and I'm going to go ahead and change it back to a lender paid transaction. We'll scroll back down to LD Wholesale. Here's our 3.5 costing $5,068. Now we can go ahead and click that, and it will then go and show all the rates that are available for our client. So 3.5 is right here, which is the 5,068. But as you start going slightly up in the rate, 3.625, 3.75, 3.875, then you start seeing that the costs for the rate is going down. So it costs 5,000, then we go up an eighth, and now the cost is down to 28.80. We go up another eighth, it's $595, and now we're in the green. Now, once the pricing turns green, this amount of money is what we call a credit, a lender credit to the borrower to pay their third-party closing costs, title, escrow, impounds, anything that's a third-party charge can be paid with this lender credit. Okay? So, for instance, if you want to give someone a no closing cost loan and your closing costs on your deal is $5,000, then you would want to offer them a 4.125% because 4.125% will give the client $5,097.60. So that would cover all of their fees in that scenario. Okay? Lender credit typically is not for the client to get cash back. So you can't bump them up to $8,761 and then the fees are only $5,000 and think that they will get $3,000 cash in their pocket. That's not how that works. You only can offer lender credits for the fees that are actually listed on your loan estimate and final CD. Okay. Over here, you can take a look as well, and you'll see that this will tell you how that rate was calculated. It's telling you that the loan amount is greater than 15 years, and the loan to value is between 75.01 and 80%, and the credit score is greater than or equal to 740. Those criteria right there are giving our client a 0.5 in the positive. So if it's a negative, that means that they're actually getting money for that. The fact of the loan amount being between $300 and $374,999 is a cost of a quarter. So if you add these two together, negative 0.5 plus 0.25, you come up with a negative 0.25. Then you have to include the broker compensation, which is 1.5%. So that's how we get to that 1.584 charge that the borrower would see. Okay. So basically, just to keep it simple, when you're pricing your loans, anything in red is a charge, anything in green is a lender credit, but you do not want to give over credit to your client because they will not get cash back for lender credits. It's only to cover the actual fees charged on the loan. And that is a quick overview of LoanSifter. It's a really handy tool. It allows you to be able to give your clients real-time pricing. I do always recommend that you sign up with your lender directly to be able to get a username and login. Every loan officer can get their own unique username and login to the lender's websites so that you can price directly on their website. And then you can also see the flow of your loan on the website. So you don't always have to check in with processing on the status of your deal because you can log right into the lender's site directly and see tracking information and if there's conditions needed or whatever the case may be. All right, so that is our overview on LoanSifter. And again, if you have any questions at all, you can call or email me 916-705-4038. Or email me at Felicia, FELLICIA.Howard, HOWARD, at elitemortgage-ca.com. Thanks so much.